All right, that's it for the news for me here today, guys. Tyler, let's now move into our segment we've been doing on these Wednesdays, which I really, really like, called Jedi Options. And, if you're out there watching the show right now, and if you're a veteran of our community, you already know the depth that Tyler Craig has in the options market. Has been studying it, trading it, teaching classes around it for the better part of 15 years now. So whenever I get a chance to listen to Tyler geek out on options, I enjoy it. And that's kind of what the design of this segment is. Tyler finds a candidate that is a trading candidate, and he finds a couple of different ways to play it in the options market and presents both different ideas to us and the community out there. And then we get to pick them apart and kind of talk about what we like, what we don't like, and how we would approach that trading idea. So Tyler, you are now up for Jedi Options.
Oh, I'm in.
I got my Padawan here. Listen up, Gino. You'll learn something.
Hey, there we go. I heard you were talking today, Tyler. I said, I'm jumping in, man.
I'll make it worth your while.
Okay.
In commemoration of the Bears coming out of hibernation, we're going to take a look at a bear pick, and I'm going to go right for the growth area of the market that has been under the most pressure. We're going to take a look at Etsy. And a couple things I like about this particular price chart. We have a completed topping pattern here. When we broke 190, 185, that was a pretty major support zone. This apparently puked it up on earnings, was underwhelming. Numbers weren't great. Market hated it, and it got hit pretty aggressively. Since that earnings announcement, we have been unable to get above about $171. So you got what I would call it a low base forming here. And I think we could see continuation lower. As a result, I'm entertaining a bearish idea. So there's a couple ways we could play this. I'll tell you, though, that the only thing that concerns me about this particular chart from a technical analysis perspective is just that it's gotten beaten up a lot. And it has held up okay over the last couple of days. Maybe it tries to fill the gap a little bit and gives you a better entry point, but it may not. And so I want to be open to the possibility that this just continues to go sideways to down. So that's the chart pattern. If you want to wait for a trigger, you could wait for it to take out the low, maybe 157, and complete this low base. Or you could do something in anticipation of that. So I've got both a bearish cash flow play and a more directional bearish play. So let me start with the cash flow play, which I think is the easier of the two. It'd be easier for me to pull the trigger on this one than the second one. Old support around 190, I think, will become resistance. Even if this is able to fill the gap, I think it's got its work cut out for it to get back above 190. So I like selling bear call spreads up there, essentially selling these call options, receiving some premium. We're essentially betting that those calls will expire worthless, which they will if Etsy doesn't get back above 190. So we're going to go out to June, 37 days out. I was looking at selling the 190 call, which has a 20 delta. Actually, no, I was looking at 195. Sell the 195 call and buy the 200. This is a bear call spread. You get about 53 cents, which is about a 10, 11% return. If you take a look at the chart, I'll put a box at 195 here. Essentially, we're wagering that Etsy stays below 195 for the next month, which it would take a pretty big recovery to get back up there. You'd probably see momentum and growth stocks come back into favor for Etsy to get all the way back up to 195. I just think in light of the current environment, that's a pretty low probability of us seeing that happen. So that's trade number one, June 195, 200 bear call. Any questions on that one before I go to the second one?
Yeah, a couple things. Can you give me an implied volatility, chart at the bottom real quick? Obviously, they had earnings recently, so they would be going through the volatility cycle that we are traditionally expect around the earnings season. The crush did happen, and over the last week or so, actually, the vol has picked back up. It's now trading up near 32%. So you're getting relatively higher IV than you would normally get. And for usually about a month to 6 weeks after an earnings report, you'll see this kind of fade or sit down near the bottom. So, okay, I just wanted to look at that to get some context on that. And then just one quick question on the strikes. What was the delta on the 195 that you picked?
17.
Okay. Got it.
17
Okay.
delta.
All right. Go into the second part of the analysis then, and then I'll give you some feedback once we hear it.
Yeah. And to Tim's point, just so we're clear on this, the higher IV is what allowed me to go further out of the money. So what's happened over the last couple of days with tech getting whacked, with volatility increasing across the board, we looked at the VIX for the NASDAQ earlier today. That is working to the benefit of this particular strategy. Had I done this the day after earnings, we wouldn't have been able to go to 195. So, all right. So the second idea is to go more directional. And we would basically be hoping that this bear retracement or this low base follows through to the downside. So I'm going to need this thing to have another down leg to make money on this next strategy. But I like the idea of maybe buying the June 160 put option and then hedging that or reducing the overall cost by selling a June 150 call option against it, looking for Etsy to drop down below 150 over the next month. So the probability is going to be lower, but we're going to have a much higher payout if this thing takes another leg lower. So I would stick with June because I really don't want to go all the way out to September. If it's had a July option, we could consider building it with July, but I think June is fine. So nothing really overly complicated here, just buying the first strike out of the money, the 160, and then selling the 150 against it. I want to do a $10 spread. I think $5 is too narrow. It doesn't give it enough room to really grow from a profit perspective. But $10 spread, paying $4, I can make 6. So I've got 150% potential return if Etsy drops to 150 over the next month. And it's obvious. I mean, it's got an ATR of $11. All it's got to do is drop one ATR. So I'm not asking for much here.
Let me see that trade tab real quick if we can. So you're building these both in June. It gives you 37 days to execute the trade. You're thinking from that timing perspective, like swing position trade that you'd be holding it into. Maybe on the delta trade, the bear call spread here, you pay 40% of the spread. That's standard, pretty traditional for the way that you've built that. I'm looking here though, Tyler, do we have an opportunity to open that spread a little bit more? Etsy's a huge flyer. I mean, 10 points. That's like 2 ATR for a stock like this, right?
It's actually 1 ATR.
Is it 1 ATR? It's just 1 ATR on the spread distance. So do we have an opportunity to maybe open that more before we dig into that? Did you look at those strikes?
Certainly. So one of the beautiful things about options is there are probably 10 different ways we could structure this debit spread, and it comes down to how much do you want to pay, and like what's your risk. Desired risk, right? So the incentive to keep it at $10 is simply to keep the cost cheaper and the risk cheaper. If you said, hey, I'd actually be able to buy multiple $10 spreads based on my risk rules, okay, well then, yeah, let's widen this out and let's maybe entertain a 20-point spread.
Well,
you're going to get a much better risk.
Can I ask you a question on that?
Yeah.
How do you weight the cost of the trade versus structuring the trade the most efficiently way you can? For example, come back to the chart here. A 10-point target on Etsy is literally it's a day trade in volatility.
Yeah.
I mean, that's what Etsy can do. Technically, I would target probably in the 140 range on T1 here, right? It's an old resistance channel, certainly could act as a new support level. So my question is, how much do you take into account your targeting when you're deciding what type of option to sell? Because wherever you sell that option, you are capping your return to a certain extent there too. Right. So you might be lowering the cost a little bit more by selling the 150 or buying the 160, selling the 150. But if you sold the 140, yeah, you're going to pay a little bit more, but you're going to make a little bit more too. So I'm just trying to, I guess, how do you square that cost versus efficiency conversation?
Yeah, so I think if cost wasn't an issue, if you had a large enough account where you could build any bull put spread, any bear put spread you wanted, right? Let's say that you could risk at least $1,000 a trade, and pretty much anything we structure one contract is fair game. In that case, I think my choice number one would be where do you think the stock's going to go? Let's take full advantage of the expected move by not capping the gain until it gets to the target. So in that context, yeah, 100%. My default would be a 160, 140 if that's your target, 20-point wide spread.
Like for me, technically speaking, I love the bear put spread here, by the way, but technically I'd be targeting 140 by 120. Technically,
140 by 120.
So,
yeah.
Yeah.
Well, and so, yeah, so I think anywhere in that range, 160, 140, 160, 130. I will say, you might say, well, at what point is it not worth it to sell the short?
It's not worth it to do that. Yeah.
It's like typically you want to reduce the cost, maybe 25, 30%. So if I'm going to pay $10 for the 160 and sell the 120 for $1, it's like I'm not really reducing the cost enough. So it's the 140 is kind of I think 140, 135 would be the sweet spot in terms of how much you're reducing the cost of the long
Yeah,
run.
and I think you and I are talking the same thing. What I was suggesting was my target at T1 of 140, selling the 140 is still a fairly conservative option to sell.
Yeah,
right.
Correct.
Yeah, it doesn't make any sense to sell the 120 and just bring in a buck.
Yeah,
I like the 140. I like the 140. I like the open interest being higher there. It's a little bit more liquid. You still get 30% reduction against your overall cost on your long put option. I do like the 140 there for that. So now
I just think if you're going to do the 10-point spread, you might as well just do a bear call. I mean, and do the credit spread. Yeah. Take the probability.
Anything else you want to add to the analysis before I give you my feedback as well, Ty?
The other thing that I will add with the 20-point spread is it also goes closer with the general guideline that we give with debit spreads, which is to get a net delta of 25. So to get that net delta 25, you would have to do more of a 20-point spread. I'm buying a 44 delta, I'm selling a 20 delta. My net is almost 25. That would be more in harmony with the general guidelines on the debit spread as well.
I mean, that 140 really does line up for a traditional bear put spread.
Yeah.
All right, so I'll go throw in my 2 cents here. I like the bear put spread as well, just like Matt's talking about. I probably already hinted at that the way I was asking the questions. I don't mind the bear call spread. I don't think it's like completely untradeable in that regard. It's up above an old support point. It's in that middle of that range. You do have some cushion. The ATR, being $10 though. I mean, we're at 160. That's 195. About 3.5 ATR, 3 ATR or so. So you got a little bit of cushion there, but I don't necessarily love the return against the delta risk. And Matt, you understand that concept really well. Some of the metrics that we use internally through our Tackle Theta spreadsheets, getting only 53 cents credit. If that was a 90-cent credit, Ty, I might be leaning towards the credit spread.
What was the delta?
53 against 17 delta. So we had a 53 cent credit, $447 risk, 17 delta. So a little too high on the delta for me for that credit amount, because a stock like Etsy with volatility up and how fast this one flies,
it would violate Royd rules.
I want to be compensated more for the credit spread. So I would completely lean on the delta spread debit spread.
Yeah. And let me add to what Tim was saying. Just doing a quick Royd factor, that would violate minimum standards when you're taking into account probability versus cash flow received, which is what the indicator Royd does. It takes your ROI received on a credit, divides it by the delta, and gives you a standardized metric of what we're looking for at Tackle, given, if you're getting a 10% return versus a 20% return on a 10 delta versus a 20 delta. So I love Royd because what it does is so many times we can geek out over how much cash flow we're getting, right? Oh, we're getting a 10% return on a monthly basis, or we're getting 8% or 20% on a credit spread. It's like, well, the quality of that return varies based on the delta you're selling, right? And so Royd really does take into account the probability versus the cash flow. And so because it does violate those minimum standards, you're probably not getting enough cash flow for that delta, quite frankly. And a lot of that is because of the volatility crush. Yeah, I know volatility's V-shaped on this chart. It's not real yet. That volatility is still coming out of earnings to a certain extent. So you're just not getting the return to justify the probability. And Tim, whenever you ask a question regarding opening up a risk graph, yes, it does lead me to believe you like the Delta trade a little bit more. Instead of Tim being like, well, yeah, but can we look at the range a little bit? No, Tim's like, let's get more money. Let's get more money. You must like this Etsy short. He was talking about opening up that risk graph without even analyzing the bear call side of it, which tells me he really likes this potential breakdown here, Tim. Would you agree with that?
Yeah, you mean the gap below the 200?
You're on mute.
Oh, no, I'm not. Can you guys hear me?
Yeah.
You're still on mute.
No,
I'm going to answer for him. He really does like this potential breakdown.
I don't think he can hear any of us.
Tyler, you speak. Can Matt hear you?
Matt, can you hear me?
Yeah. We heard all of your analysis, Matt, by the way. You just simply cannot hear us right now. I'm not certain why that is. The audio must not be coming through your speakers at this point. So double check that. But we heard all of it. He probably still cannot hear me right now, Tyler. But
I can hear you now. I had to switch the audio.
Oh, there we are. Yeah,
I can hear you now.
No, I love it.
And you're right. You like the breakdown though, right?
100%.
Yeah,
and you picked up on the cue. The second I started asking about debit spread distances instead of credit spread cushion, it was that I was leaning towards the delta side of this one as well. I like the gap down, holding the trigger point. You've got plenty of movement in Etsy, and quite bluntly, you're just not getting compensated on the credit spread side. If I can't get a little bit more out of that credit, I just wouldn't do it. So
the only question I have for Tyler is one pertaining to the market. The market's been puking up the last 3 days. Etsy's kind of holding its channel here. Does that give you any concern?
It does give me a little bit of concern. I think it's tough because you could argue both ways. You could say, hey, this hasn't broken down like the rest of the stuff. Does that give you pause? But my counter would be, did you see what it did prior to this week? I mean, it went from 215 to 160. Perhaps
this is what would have transpired.
Mm-hmm.
Correct. It's almost like everybody who wanted to sell on earnings sold, right? And then it spent a couple of days just hanging out because the weak hands at that point had been shaken out. So I would have more conviction with this directional trade if we take out the lows, because then you've got I think fresh momentum.
And my last question, technically, on the bear call side of it, you'll lob that grenade right now based on what the trend and the pattern.
Yes.
Right. You would just make that trade right now.
Yes.
On the, excuse me, on the directional, do you need confirmation under 160?
I think you're going to have, yes.
I would agree with that. I do think you need price confirmation because of what's been transpiring. Mm-hmm. Price confirmation would be key here, but I like the bear. I like the bear put side too.
And I would say categorically, just real quick, I always want a little more directional confirmation on the directional side, just because I feel like I can rely on the management of credit spreads to bail me out. Directional, you don't have much. If it doesn't work, it doesn't work. And so you really want to have conviction on the original, the setup that got you in and that it triggered in the right direction.